Welcome to Decode and thank you for joining us today. With Q1 earnings delivering pleasant surprises and macro concerns continuing to remain, today's discussion comes at a fascinating market juncture. From mid and small cap valuations, Indian IT's structural shifts, to the sustainability of the AI driven US tech rally, we have a lot of ground to cover. Let's dive right in. Sham, the result season this time has been very interesting. We all thought after the war there'll be a lot of pressures showing up in the earnings and all that, but they seem to have corporate India seems to have passed over it very smoothly. So, do you think that the risks from the war were overestimated?
I don't think the war risks were overestimated. I think it was correct. But what people have not noticed, and I would include myself in that, what we have all not noticed, is that the Indian corporates inventorized very heavily in the month of March. If you see a company which has given a result way ahead of expectations, then you will see in the balance sheet of March, because it's available now, inventory would have doubled. So they were running with twice as much inventory in March as they have in the past years. And that inventory has been bought at lower levels. Exactly in March, you saw the oil shoot up, and it happened subsequently in Q1. So they were able to pass on the price increases very comfortably to customers, and that gave a very good delta. Like your cost is low, but you're able to pass on price increases. And I think some of it will even spill over into the current quarter because such is the level of inventorization. Inventory buildup was so high. What we fail to see is the extent of this inventory buildup in companies. Now, for a long term investor, somebody who is investing across market cycles, let's say 5 years, actually this doesn't matter because this will normalize. Experience tells you that such inventory led profit gains will normalize, it will come down. But the circumstances under which this quarter played out, where there's gloom everywhere, everyone was anxious that because results will be bad, stocks will be further derated. And we have already paid more in some parts of the market. So you cannot afford a derating in those parts of the market. A large cap anyway was already derated. So on the one side, you had clear visibility and pessimism in large cap, and you had fear on the other side in, let's say, mid cap or small cap. I think that fear got relief through this result season, where I believe that inventories have played a very big role.
Okay. Does that mean that the macro risks are now minimal or the risks are not as much as it was in the last few months?
Macro risks are definitely going down, but I won't say they have gone away. Even today, oil is $90. That's not low because on the one side, you have oil at 90 and rupee at 96. So the macro headwinds remain. You also have the El Nino impact, which is inflationary. So macro headwinds remain. I don't think they are going away anytime soon. I would think the macro headwinds will go away when you have put inflation behind and you are seeing supply much better than what was anticipated. So when you see that, you know the risk to inflation is coming down, which in turn reduce the risk to liquidity in the economy. It does a lot of things, right? It makes people consume with more confidence. So all those things are yet to play out. I don't think the risks are gone away. If oil goes to $75 or below, then I would think that the risks are going away. But it's always bounced back, and the bounce back has been quite strong. So I think macro risks remain. We have to be always vigilant.
Okay. Do you see any particular sectors or segments which are more vulnerable now, which might have done well or scraped through in the first quarter, but maybe more vulnerable now?
I think you should talk at the company level. Many companies which showed very high profit growth in this Q1 have benefited from inventory gains, as I said. So those companies, I believe, would get sold when market realizes that these gains are not a trend. Like when you see the margin expand by 20-30%, people got very excited and the stock price saw a pop of 10%, 12%. But today when you see, those companies are actually getting sold, slowly getting sold. So I would be very careful uh, in such areas, because that is where you should be very, very careful. And broadly, it's more in chemical based and petrochemical based value chains that this has happened. One should be very cautious. Also, anybody feeding into the AI boom must be very careful, because I think um, the capital that is fueling AI may not be available in the future in the same extent, or to the same extent it is available today, which means there will be a definite slowdown in investment cycle related to AI globally. And when that happens, anybody who is feeding into that and showing disproportionate, aggressive, short-term growth, and you are discounting that growth as a trend, is at a risk. Anybody who is doing all these things is at a risk. Any sector, any company which is benefiting from all this should be viewed cautiously.
Okay. Moving on to mid and small caps. Our earlier narrative was always that valuations are very high, and now if these macro risks play out, earnings compression will happen, and so it's a risky bet. But since April, if we see markets, mid and small cap indices or have done generally very well, much better than the Nifty, and results also show that these earnings have been strong. Uh, Fund flows also show that domestic investors are flocking to mid and
Same.
small caps. So you think that the valuation reset has already happened, because in 2025 the correction was for that essentially, isn't it? Or are there still pockets which you find expensive and you remain cautious?
See, with respect to mid and small cap, what we see today is a function of aggressive inflows. That's the first thing. The second thing that you're seeing is that concentration of capital in certain themes, which is making those themes extremely expensive. Like, who would I imagine that CNC machines will sell at 100 PE? It's a very difficult sector, long cycles, right? So you look at all the places where the valuations are elevated, all of them are very long working capital cycles, very long cycles, very few customers actually. You will see whether it's defense, aerospace. Aerospace is two customers in the end. Defense is one customer. Uh, Likewise, so all these companies which have seen a massive expansion valuations have very long cycles and feed into very narrow customer bases. I think when you overvalue or when you liberally value such businesses, you are definitely increasing the risks in your investing. I think these risks will definitely come back to haunt when growth slows or when investors get bored. The same story can bore people after some time. They are looking for something new. Today, nobody is talking about solar. 2 years back, everyone was talking about solar. Actually, if you look at the performance of solar companies, they're reasonably good. They've done well. But stocks have got derated. Now, this was one of the hottest themes 2 years ago, 3 years ago. And it was not valued excessively like these other themes that we are seeing. So I think when you overdo valuation and you become very, very excessively generous in valuing businesses, which feed into very narrow customer bases, I think you are running a future risk. So I think this will come back to haunt. That is my view. And this happened in the past. Y2K was a good example. 2008's capex boom was another good example. 2018 small cap boom, people have forgotten, was another example. All the government did was did a recategorization of funds. Funds had to sell and buy. Sell certain companies, buy certain other companies. They didn't have outflows. Just the fact that they had to sell certain companies and buy certain other companies created so much impact cost that suddenly the returns vaporized in 1 year in 2019. Another recategorization cannot be ruled out, and if it happens, the same trend will happen again and it will repeat.
Okay.
Because too much capital chasing the same ideas is always a risk to the market.
Okay. So you still continue to remain cautious on
Wherever valuation is elevated and I see businesses feeding into a narrow customer base, I am cautious.
Okay.
However, wherever valuations are in favor and I see that the market is not willing to see the positives of that business, I could actually be bullish. So it's a very polarized and a divided market.
Okay.
Where we see popular themes and overvaluation in those popular themes, I remain cautious or negative. Where I see unpopular themes which are valued very, very favorably to us, there I am inclined to be positive.
Okay. Shyam, one sector which had probably a forgettable quarter once again was IT. Now, if you go purely by valuations, you see very little downside risk. But for growth investors, the question is essentially when will growth be back? And when will this AI led disruption turn into opportunity and lead to meaningful revenues as well as profitability on it? So, and we have been giving a call on tech funds. So, how do you think this is going to play out to the next?
See, from a value investing standpoint, IT looks very, very interesting. And there are reasons for that. If you look at how the global IT companies in the service businesses, just like our Infosys, you have Cognizant, you have Capgemini, you have Accenture, you have so many global IT companies. If you see how they got derated in the month of June, July, they went to low single digit P, almost 5, 6, 7, something like that. The P ratios became half in a very short burst of time. But they've recovered subsequently. And this recovery has coincided with the derating of AI and the doubts on the sustainability of the investment into AI.
Yeah.
That's what basically has recalibrated valuations in these companies. But if you look at the Indian IT companies, here also the valuation fell by half from the peak. All the companies lost 50%. The valuation literally fell by half. But subsequently, Indian IT companies have not been able to bounce back by even 10 or 15% actually from the bottom. The reason is that they are not able to give guidance on how soon they will be able to get back on a growth trajectory and what that trajectory would be.
Yeah.
But if you see what is happening in their businesses today, they are definitely compromising, or rather, they are adapting their pricing. When you adapt your pricing and you try to give better value to the customer, it will appear that you are not growing. Let's say you reduce price by 10%. That is your growth, that is gone. Even if you are growing, you will be looking like you are doing the same turnover practically. Suppose your growth is 5% in business, but in value terms, you have given, let's say, discounts or you reduced your pricing. It look like you're not growing at all. Market is not liking this, and market is in a mind to punish this. But on the other hand, let's say 20-30% of their business or 40% of their business becomes higher value added services which are in the domain of AI, which I think will happen over a period of time. Maybe it may take 2 years, maybe a little longer. As you progressively move towards that, the market will start recognizing this. And also, I believe that if the global companies like Accenture change their commentary, which I think is bound to happen over a period of time, then domestic investors will also follow suit. Today, you're not paying for any of this. That's the reason I feel that from a value perspective, it's a very interesting spot. And these companies have adapted. If you became bearish after Y2K and thought the IT boom is over, 25 years later, how do we be sitting here? Just answer that question. Yeah, margins go down, but that's been the trend from 2000 itself. It's been the trend. But I believe now that trend can also change if they are going to offer value-added services using the current challenge. And when the companies rise to meet this challenge, if they are able to do this better to a good part of their portfolio, such companies will again start being perceived differently by the market. Valuations will definitely be seen favorably and people will be opportunistic in investing in such companies. So I think it's a cycle. Today we have factored in all the negatives, and domestic IT companies have not factored in much of the positives.
Okay.
Global IT companies first factored in all the negatives, and slowly they are coming out of that. In fact, they are moving much better than us because they fell earlier and they fell more.
Okay. Okay. You did mention about the AI trade losing sheen. Now, we did see the tech and the semiconductor companies coming out with good results. The outlook is also very good for them. But foreign investor interest has deviated. And everybody is in two minds now because they are still moving up and doing well, and earnings is also very good. Now, do you see a repeat of a dot-com like burst coming up very soon?
See, I don't want to be, some kind of propounder of doomsday scenarios, but I can say this much. I see a lot of hedge fund selling in these IT companies the last few months. I think they've been selling very aggressively. And we also see that the VIX in US is at a low,
Okay.
the volatility index, which means that there's no fear in the market. So while the large hedge funds are selling and the VIX is low, who's buying? So it's basically the American retail investor and the global retail investor who is going and buying all these things. The time to buy this kind of business when the VIX is very high, not when the VIX is very low. I think people are playing it by thinking that these peak profits will continue to grow. So you are having peak profits being discounted in a particular way without factoring in what will happen after if there is a slowdown. The question is when this slowdown will be. If you see the market's lack of fear, it thinks there will be no slowdown. I think certainly there will be a slowdown. And when that slowdown happens, the market will have to reset itself. So that's the sense on the US, especially AI driven companies.
So, what do you have to tell these kind of retail investors who have gone and invested in this? Are they supposed to be coming out and taking a look at the Nifty, because the Nifty has been flat for the last 2 years, and we are telling that large cap companies in India are attractive. So, how should they play around with their global versus domestic asset?
See, I do not wish to talk down to any retail investor, but because I've also been a retail investor and grown, so the idea is not to do that. But I would always be careful when valuations are not in favor and when valuations are very extreme, when they are in uh, a phase where you are discounting peak profits generously. So at that time, I think you should slow down and you should move to safety. I don't see that movement happening amongst individual investors. In fact, many people think that if you move to safety, you're a non-performer, right? So suppose I consciously choose to move to safety in my portfolio and say I'm going to be sitting in a safe place. This is not okay. Most people think of it as a weakness. I think that's a howler for me. That means that people are overconfident, and this is not a time to be overconfident in businesses which have benefited in recent times because of this boom. Because once things slow down itself, you don't have to see a bust. Even a slowdown is enough to affect your portfolio quite a bit. So I think it's a time to be circumspect, cautious, and you should lower the risk in your portfolio. I'm not saying you should exit equity, but you need to do risk management dynamically in sync with where the market is going. Looking at the hedge funds, they seem to be doing good risk management in the US, whereas the retail investor is not doing the right risk management as far as the US market is concerned. That's the commentary that I get to see. People are mocking others like, let's say, Fundsmith or Seth Klarman or Bill Ackman. That's the kind of narrative you're seeing. In India, again, you are seeing this blind worship of the small cap and mid cap space. On the other hand, if the economy is doing well, the micro caps should be at near their highs. They're nowhere near it. SEBI has stopped inflows into a micro cap fund, index fund. So there is something which is brewing there, which is identified as a difficulty. I think today the Indian investor is being utterly disrespectful of value investing at a time when they should actually be using it effectively to protect their downside. That for me is a bit of a warning bell.
Okay.
That's how I see this.
Okay.
You should be aligned to value at this point in time. I'm not against growth, but you should buy growth at a reasonable price, not at any price. And when growth is trading at any price, you should align yourself to value. That means you can return to growth when it comes to a reasonable price. That shift, calibration in India is not happening. It's refusing to happen for a long time. And when it refuses to happen for too long, the market will force it on people. I believe that is bound to happen.
Okay.
It's better investors voluntarily, take refuge in value, seek protection in value, so that they could go back to growth when growth stocks are available at reasonable prices.
Okay. Always buy growth at a reasonable price. Use value investing effectively to protect downside before the market forces you to reshuffle, is the key message from this conversation. Thank you for watching. See you in the next episode of Decode.